let me come from the beginning for the benefit of whoever is missing it. So now we are looking at valuing a firm. So valuing a firm means getting the right price of a firm. Essentially, what it means is the present value of future returns of a company or an organization. So these future returns, in this case, as you can see in a formula, it says payoffs, future payoffs. The payoff can be dividends, it can be cash flows, it can be earnings. So we look at these payoffs and bring the collective value of the total value of those payoffs to the present value using a discount factor. Then you get the present value. So present value of future payoff is your value. So I was discussing, it is not easy to get the payoff straight away, although it is simply put here in the formula, because we have to predict the future with a lot of uncertainties. So we use assumptions, we use estimates. Now, one thing we need to understand is that we are not trying to get the present value of cash flows. We are not trying to get the present value of earnings. We are not trying to get the present value of dividend. That is not what we are trying to get. We are trying to use dividends, cash flows, or earnings, whatever the future payoff we think is appropriate in our calculation. We are trying to use them to get an understanding about the intrinsic value of this company, right? For me to value this company, I'm using dividend or cash flow earnings as a source, as a reference. Therefore, ultimately, what I want to find is the value of this firm. Because I don't have a direct reference to value the firm, I am using the dividends, earnings, or cash flow as an approximation. So my objective eventually is to get that value that is not known. So some people, without looking at any of these, they simply look at the company, look at other qualitative factors. They say, okay, this is the price. Right? This is the price. I have dealt with some of the high net worth business people in this country for certain. Right? Please, if you can put yourself to sorry, there was a disturbance. Right? So I have dealt with some of the high net worth business people. Some are not very sophisticated or professionally qualified people. They are just businessmen. So they have high net worth. So they take decisions. So I happen to deal with one such high net worth individual, probably within the top 10 richest people in this country. I was quite surprised and impressed the way that person negotiates. So I happen to represent one of my clients in a property sale, and the investor guy, the businessman came. He came without any support, right? Without any assistance or accountant or anyone. He just came empty-handed. He sat on a chair. So we went prepared with our cash flows, calculations, NPV, all kinds of things. We have all that. So before I explain the stuff, he started the conversation and he started talking about the facility. Okay, this is what the facility is all about. I know these pluses are there, and I also know that these problems are there in this place. And from what I know, this is what we can use this property for. These are the benefits and all. He just gave a very high-level brief and said, having considered all of this, this is my price. I propose this. This is the value of this company for me. That's it. And he doesn't come up with any calculations or any this thing, nothing. So this is he gave a value. Now that is another way of giving a value, because the point here is that we need to understand you can't go and challenge that by saying, no, your value is wrong. Because there is no right value as such for a company or a share. It is all about how the people who deals with the transaction perceives it. Right? If I feel that this particular item or property is worth this much, that is the value for me. If another party feels this is the worth of this particular item, that's the value for that person. Now, when it comes to a transaction, what is important is to bring the two parties to a common place, right? If I say it's 100 million, another party says 150 million, the deal never happens between the two. So you need to bring both the parties to a common thing. Okay, let's come to a middle path, 125 million or 130. So, okay. So that's the ultimate thing. Therefore, with these calculation, what we are trying to do is, remember, we are not trying to figure out the percent value of dividend, the percent value of cash flows or nothing. These are all tools or references we are using just to ascertain what would be a reasonable range for this particular item. Okay, when you calculate the present value of future dividends, it gives you a figure. That gives you an approximation. Okay, the value of this business is somewhere around this. That is the idea, right? So don't ever challenge based on this numeric mathematical calculation to say this is the exact value of this. No, you can't. So you can say, what is the height of me? People can say is 5 feet 4 inches, 5 feet 6 inches, 6 feet. You can argue, but you can measure and see his height is exactly 5 feet 4 inches. That's it. No one can challenge because it's a given after that. But the value of a company is not like that. Right? Value of a thing is not like that. Value of a share is not like that. However much you calculate, still can be challenged. So therefore, it's very important as professionals we need to understand that part. That's why we always say when we even quote a value for a company or a share as a professional, we generally do not recommend giving a point valuation, the specific one. The value of this company is 225,000. No, we say the value of this company should be based on our calculation, based on these consideration, it is somewhere between 200 to 250. So you give a range so that let the party to the transaction play within that range and come to an understanding of agreement. It's very important to understand this practical aspect when we deal with it. Otherwise, you simply go and use this formula, calculate using any Excel or any other calculator. You come up with the figure and you take it as the ultimate truth, which is wrong. That is very important. I must say that at the beginning. Right. So I reiterate my point again with this particular slide. Right. So if you look at this slide, you can see forecast of income, statement, balance sheet, statement of those are the financial statement, whatever you forecast. From those forecasts, you derive the dividend free cash flows, earnings. So those are the payoffs that we get. Right. Now, based on those bases, right, we identify methods, right? When your consideration, when you use dividend as the basis, you call those valuations dividend-based valuation models. When you use cash flows as the basis or free cash flows as the basis, you call it free cash flows based valuation models. When you use earnings mean in this case profit, right? Then you call it earnings based valuation model. Now, these different valuation models, we are looking at different perspectives, right? So the dividend based models we look at from the wealth generated, distributed wealth, right? So dividend is not what the company is earning. Dividend is what the company is distributing back to the investor, right? So based on what is distributed, right, what the investor can get into their hand, how you value the company, because that is a real thing you are going to get eventually if you be part of this organization as a shareholder. That's what is coming to your hand, not what they earn, but what they distribute. Second perspective, when you take cash flows, that is distributable wealth. That means however much the cash the organization is generated, that is the cash balance available for distribution among the shareholders or the investors. So distributable wealth, right? And then finally, we have wealth creation. How much wealth you have created? That is what you have generated, earned, right? So for the benefit of those who are focusing on the match, let me repeat this because now the match is over. We won the match. Now we can concentrate here. So we were discussing about valuation. There are three approaches: dividend based, free cash flow based, earnings based. Now, eventually, there are different perspectives, but ultimately we are trying to figure out the company's value. These are three different approaches, right? Paths we can take to find that value. Now, here we explain the different perspective. The dividend is what is distributed to the shareholder. Cash flow is what is available for distribution. Income is what is created, what is generated in the company, right? So it depends on which path you have to take. And also, when you want to pick which base you want to use in finding the value of a company, you need to look at the circumstances as well. Say, for example, if you are trying to value a company, newly created company, right, maybe 1 year or so, which has not distributed dividend in the past, you can't use the dividend base because there is no history of distribution. Then that model won't work, right? So likewise, sometimes depending on the situation of the company, you need to value. For example, there can be a company which has a 20-year history. But for the last 20 years, the company has distributed on average just 2% dividend. So out of the wealth created, they have distributed only 2%. But if you look at that company and try to value the company based on dividend, you are undervaluing the company because you are just taking 2% of what has been created and then trying to figure out the value of the company based on that, which is wrong. Then dividend is not a good indicator to get the value for that company. You must use one of the other two. Likewise, it is very important to understand why we take these paths and how we are eventually getting at what we want and why we take these routes. The reason why we take these routes is because there is no clear-cut, precise mechanism to get the value of a company because that value is not a specific figure. The value of the company depends on how you justify your case. Say, for example, for one person, let's say take a house, right? Let's take a house. You are selling your house. You say the value of the house is 20 million. How you arrive at that value? You talk about the land prices, right? You talk about the land prices in the surrounding area. You look at the material you have, if it is a tiled house or a cement on roof, then roof, what is made of, whether it's AC or otherwise, you look at all these things. Then you look at the garden and the rest of it. Then sometimes you also want to capitalize on the fact that the house is located near a river, right? So there is a natural beauty coming to the house because of the river. You add a portion of value to that as well. Then you say, okay, that is taking everything into account, and I say it's 20 million. But there's a guy who wants to come and buy this house, and that guy doesn't like rivers. He hates water. So for that guy, when he put the value for the house, he will not consider the river factor. For him, it's just the house and the rest. Then his value is different to the guy who is selling this. Right? And there can be a guy who was waiting to stay near a river, he's dying for it. So he will give a very large premium for the river factor. So now you see how a value of a company or a value of a property or anything can change depending on the perspective you take, depending on the factors you consider. Therefore, I must tell you again, when you look at these approaches, these are only mathematical models for you to get an approximation, and then it doesn't mean whatever the outcome, the final figure is the value of this property or the company. Right? Take that into account. So I'm expecting that kind of open view from you all when you, even especially at the exam level also, because I don't want just to replicate the textbook models and calculate numbers. What I want is not a number or figure. What I want is the knowledge that you gain as to what this really means in the real world. Right. Any questions? Any questions? Great. Let's move. Now, we focus in this presentation one approach that is called cash flow based valuation. Cash flow base is distributed wealth, right? Distributed wealth. So the cash flow base, whatever, sorry, not distributed, the distributable, right? Distributed is dividend, distributable, what you generate in terms of cash. So here we look at cash generated flew into the fund. And there's another term called free, right? Free cash flows. That means it's not the gross cash flows you are generating, it's the cash flows that are freely available to be distributed to the shareholders, right? That means after calculating your cash flows, especially if you look at your operating cash flows, whatever you calculate, you have to also reduce other commitments or the committed cash. For example, if you are a company with preference shares, from your operating cash flow, you will also deduct the dividend for preference shareholders. It's a given. It's a commitment. So if there's a commitment, it's not free. So you reduce that commitment or committed cash and then get what is freely available. Right? In other words, the cash ultimately left in a firm that can be distributed to the shareholders. Or in other words, the cash you can consider for dividend. If you pay 100% dividend, you should be able to give away all this cash. That is what we consider as free cash. And also, it is different, right? That I think we have explained this part. So cash flow and dividend payment is different. So we don't need to mix up the two. We are looking at not what is distributed. We consider what is generated, right? But in the long term, right, although there is a lesser amount being distributed as dividend in the short run, in the long run, whatever the money came to the business versus what has gone out of the business should be equal. That's a fairly understandable logic, right? Because what has come in has to go out at some point. So in the long run, these two matches, right? Now, then the thing is, I told you, when you value a company, you need to find or identify, we discussed 3 different approaches. You need to identify which approach we take in calculating the value. Is it a dividend-based approach, cash flow-based approach, or income-based? You have to figure out which approach you want to take. So when you take that, you also need to justify why you took that approach. Right? And here is a rationale. If someone is picking the cash flow basis to calculate the value of a firm, these are the reasons or justifications as to why cash flow is good or better. Cash flow is the ultimate source of value. Why? In the end, irrespective of whatever you generate in your P&L, you can have whatever the number as your profit, but that is meaningless. It's just a book entry. You can have 100 million book profit, but that 100 million you can't take out. So it's just a number in the books. But cash is something that you can really materialize. You can take out, right? That is why cash is considered the real source of value. Irrespective of your profit, whatever the cash you generate in the business is the real value. And also, this cash is what can be distributed to the investor, right? So if you can really extract the value of a company through cash, therefore cash is the best approach. I'm just saying whoever is using cash flow, how you justify it, right? I'm not saying cash is the best approach, but why cash is best is what is justified here. And also, it's a fairly easier to determine or measure, because cash is something that you can trace, right? If you put a figure, you can trace it. No? So cash has to come in to your bank account or any other place in a solid form, right? As a check or cash or anything, but it comes in a solid form, unlike arbitrary estimated book figure, right? You can park anything as income, but you can't do it with the cash. It has to come at some point in real cash. So therefore, it's a fairly easy, commonly measurable denominator or a factor. So it is therefore good. Now, these two factors, points together, helps you to justify why cash flow basis is good and why cash is relevant and important. Then comes when in our equation, so when we calculate our value, discounted figure, you have the future payoff and then you discount it to arrive at the present. So when you discount, you need to now identify what is the discounting factor or cost. Now, when you look at cost of equity, if it's 100% equity based company with no debt, we need to now calculate what is the cost of the equity. So there is this model called CAPM. Some of you may have learned this elsewhere in your previous places, maybe during your degree or your professional course, you may have learned it. This the idea is we are trying to derive the cost of equity using the CAPM model. So CAPM model is a tool to derive the cost using the other available market information. You get the market interest rate, so market return, risk-free returns, all this market information, what is available in the market, you collect, and then through them you calculate the cost of equity. So CAPM stands for Capital Asset Pricing Model, right? So technically, you don't need the word model. Mere CAPM is enough, right? But that's how when you get the acronym, that's how we use, right? So the formula is expected return equals risk-free return plus beta into market return minus risk-free return. So what is this? Market return minus risk-free return. What is this? This is market risk premium, right? So the rate or earnings above the risk-free rate is a premium to capture the risk, right? Risk-free, you have a rate. Why you pay more is because there is additional risk coming into the picture. So to compensate that risk, you have a premium. So the market return minus risk-free return, this part is called market risk premium. So market risk premium into beta is a given factor there in sums. The calculations are there, but for exam purpose, you will get a figure. So it can be 1, 2, something, anything, right? That into beta, that factor, the altogether, plus risk-free. So what is this? This is the risk premium of equity, whatever the equity that you consider, because market risk premium multiplied by beta will give you the total risk premium of your equity under consideration, whatever you are considering. And that risk premium plus the risk-free, because the same risk-free rate here, right? You add the risk premium to the risk-free rate, you get the expected return. Because for this equity, the parties, whoever is putting money, the investors, need the risk-free return plus a compensation for the risk that they are taking. So this part will explain the risk they are taking, the risk premium they are assuming. So this will be the expected return after considering the risk. Right? That's how the CAPM model is explained in this scenario. And if you look at beta, right, beta factor, it can be 1, right? Beta can be 1. That means if beta is 1, what happens? The risk premium of the equity or the security under consideration is equal to market risk. So that the movement or the fluctuation of the share price or the return of the selected equity is the same as the fluctuation of the market, because it moves the same way like the market moves. That's why you have the same risk premium. If the beta is greater than 1, that means the resulting figure here will be a higher figure than this, which means if the beta is greater than 1, the volatility of the security under consideration is greater than the market. That means your risk, the risk of this company, is higher than the average market risk. If the beta is less than 1, the risk of the selected security is lower than the average market risk. So that's the explanation of beta factor, how you use it. Right. I think most of you can recall, you must have learned this before. I will not take a lot of time from you on these things. Now, then comes another model. Now, the previous model will give you how to get at the cost of equity, right? How you find the cost of equity. Now, when you have a company, sometimes you get companies with both equity and debt capital, right? Both equity and debt capital. So when you have both equity and debt capital, we need to get the average cost of both equity and debt. So this model, weighted average cost of capital, WACC, is a model we use to calculate that. So it's very simple. We get the this part, right? This part, the cost of equity into the weight. Let's say you have 200 equity, 300 debt, and 500 preference shares. Sometimes you can have preference shares as well. So as a percentage, if you take 100%, 20%, 30%, 50%. So we have to get the proportionate cost as well. So this is the equity. So cost of equity we calculated previously using the CAPM model. You find out what is the cost of equity here. So that into the weight of equity, that is 20% as per this example, weight. Then we get the cost of preference shares. Right? We can identify the cost. If there is a predetermined dividend rate we are offering, then we get that cost. That into 50% is the cost coming from the preference shares. Then the debt, 30%. So weight is 30%. Then how you calculate the cost of debt? Because what we consider in this calculation is the interest cost of debt is tax deductible. Because of that reason, there is a tax advantage. You don't consider the total interest. You need to consider the net interest after deducting the tax. That's why we get the cost of debt into 1 minus tax rate. That means the net of tax interest what we take here. So cost of equity, cost of preference shares, cost of debt, weight of equity, weight of preference shares, weight of debt. Then you add the 3. That is how you get the weighted average cost of capital. Any questions, clarifications, or do you want me to clarify or explain it again for anyone? Please raise if you have it all, because these are possible areas where you can get calculations for the exam, right? You won't get calculation for this bankruptcy model and all those complicated things, but these kind of things, there's a possibility for you to get calculations.
So are formulas given at the examination, or should we have memorized?
Sorry?
Are formulas given in the examination, or should we memorize these formulas?
To my knowledge, formulas are not given. But these are not complicated formulas. Right?
Okay, sir. Thank you.
Yeah. These are very straightforward. CAPM, weighted average cost of capital. Those are not complicated. Right? Even the previous one, payoff divided by discount rate, those are not complicated ones. You won't get things like this bankruptcy models and all those are very complicated ones. We don't get those. Right? Right. Any other question?
Sir?
Yeah.
So a small clarification now when it comes to cash flow based valuation. Now, in that case, now like with regards to the number of years, now how do we take that as a base? Now, how do we take that particular assumption? Like in the exam scenario, okay, details will be given, but in the practical scenarios, how do you do that now? Cash flow, like the number of years to be considered for valuation, how do you take that, sir? On what basis or assumption that we should consider?
Yeah, that's a kind of a tricky one because there is no rule as such. You have to go by industry norms. Sometimes when you go for professional valuers, they have some norms. They say we take 10 years, right? So 5 years, something like that. And anyway, you go up to when you have 10 years, at the 10th year, you get an exit multiplier to capture the balance period. So that's why I told you these are all estimates. There's no hard and fast rule. Probably what happens is when a deal happens between parties, the parties agree on assumptions when it comes to calculations. Right? They say, okay, or either the party who bids calculate the figure and then shares the calculation with assumptions with the other party for them to be comfortable with the calculation. If they want any assumption to be changed or modified, or then they have to agree. That's where if there's a professional valuation, a professional deal happens, there's a lot of negotiation going back and forth. They fight for the assumptions and calculations. But in real world, that's how it works. I don't know whether we have anyone in this class today who is actively involved in valuations or working for audit firms or any firm. Maybe they can shed some light here. I have been part to some of these deals, so that is how it happens in our case, especially when I am part of the things. I always do the calculation with some assumptions and in Excel with formula. So I share the file with the other party to show how we have arrived at the numbers, so that they can, if they want, they can challenge, then we can agree. So they are the main thing. Main thing is how comfortable are the parties for the assumptions used, because assumptions are the key here, because discounting factor, what is the figure you take, is 15% or 20% or whatever. If you say cost of debt, you sometimes do not know the exact cost of the debt you intend to take. So if you say debt can be debentures, it can be bank loans or anything. So what is the rate we use? Then they agree, okay, let's take, it's a long-term deal, let's take the 10-year bond, 10-year bond rate as the cost of debt. So that's the assumption we put. Then the other party might agree or disagree. They might say, no, let's not take 10-year bond, let's take 30-year bonds. But the problem is in Sri Lanka, we don't have such a long period instruments. So we practically have faced situations like this, especially when we deal with foreign parties and all. In foreign markets, you have a lot of references, right? Pension funds, bonds, all these kinds of references are there. But in Sri Lanka, small market, we have less references. Therefore, it's extremely challenging to justify assumptions. I hope I answered your question, because the answer is there is no specific number as such, but anything between 5 to 10 is what is considered generally, but not hard and fast.
Yes, sir, I got it, sir. So apart from that, like, is there now when we have a bit of a difficult situation, in that case, can we use two approaches, say cash flow and the free cash flow basis and dividend basis, or any of those two, and then get the what do you call the final figure? And can we argue on that basis? Because since we can't go give a conclusion based on one approach, would it be all right if we take like two to get an idea, and then based on that, can we do the valuation, sir?
I think that's where I'm getting at eventually. That is where I'm getting at, because you can't justify by taking one approach. Why cash flow? Why not income? Why not dividend? Other party can challenge. And even for us, we are trying to get an unknown value. We use different paths. Okay, let me go through cash flow path. Let me go through dividend path. You can have different paths. So you arrive at the figure. Now, if you calculate the figure, let's say the same company, you can get all these information. You have dividend details, you have cash flow details, you have income details, you have everything. So if you calculate the value using each of these three methods, ideally, if we are looking at a particular magical number that is hidden somewhere, we are trying to uncover that. Ideally, we should be getting the same value, right? It's like I want to go to Kandy. I go in different way. I go to Puttalamo somewhere and go to Kandy. I go to Avisavel and go to Kandy. I go to Kadavata and go to Kandy. Ultimately, all of us must meet, right, in Kandy, if that is one specific point. But in this case, when you follow different approaches, you will never get the same figure. You will always get a different thing. Cash flow basis will give you 5 million. Dividend basis might give you 3 million. Income might give something else. Always there's a gap. So it depends on how you justify the appropriateness of the basis you take. You follow? So that's why it's such a difficult task. So here, these things, that's why we are at MBA level, master's level, right? That's why I would like these to be challenged, right? We learn all these things in our degree and professional courses. You go and calculate and you go to a discussion with the guy with this, it's not easy. Because this is just a calculation. This is not the value of the company. This will give you a hint, right? But not an absolute answer. So what we need to do is, you as professionals can use this just to tell the other guy, when I value this company, I didn't look up the ceiling and give you a number, right? You can't just look at, oh, let me quote like this, these in temples and all, you have this alpilla. Okay, you can't tell like that. So you are a professional. So then you can say, okay, there is a science behind the number I am giving you, right? I have identified the cash flows of the company. I have calculated this. So scientifically, it comes to somewhere like this. So I have considered these factors. And then, in real life, it is not the answer you get from this formula that is quoted as the value. This will give you a price or a figure. After you get that figure, you modify that. You bring in other elements. Okay, this is the value of the company. By the way, this company has a goodwill factor. By the way, this company has this strategic advantage. By the way, this company has these partnerships, this and that. You bring in all this, right? And then you add things and okay, the calculated value is 10 million. You jack up the 10 million with few other things and okay, the quoted price is 15 million. Then the buyer comes and say, look here, yes, your calculated value is 10 million something, but look here, you have a problem. You are selling a property. Next to the property, there's a big dumping zone, right? Garbage. So it will be a negative factor for me. Let me discount 1 million from this. So the buyer will argue on that side. So you arrive at the figure, then modify based on other factors, and that is the price you quote and then negotiate. But the idea here is that when you calculate this, you come to a point that scientifically this is something. This is what we call intrinsic value. That's why even the stockbrokering companies and all how they value the share prices is that. So they do a scientific valuation, right? And then they say this is the price of the share. And price of the share is 130 rupees. What is currently traded, right? The share is currently traded at 100 rupees. They say it's a good buy because the intrinsic value is 130. It's going at 100. It's a good buy. You can buy the share because it's the price is discounted at this point in time. But this is how the scientific world work. But in real world, it is not the way it works. In real world, you always have other variables coming in and you have a point for argument. That's why by being a mathematician, you can't win a deal. You have to have the mathematical calculation know-how here, plus you have to be good at this, but you have to be better at negotiation. That's where the deal happens. So I expect those insights coming into the picture when you respond to your answers, even at the exam. So I don't just say this is the calculation, depending on how the question is about. But if the question is about some figures and calculate the cost of capital, you simply calculate and see. But if there's an open-ended question about some kind of a deal or negotiation, you have to bring in all these elements. I hope I make things clear to you.
Yes, sir. Yes, I got an idea. Thank you, sir. Thanks.
No problem. But the reality is such. Reality is complicated than what we see in the books.
Yes. Thank you, sir.
Okay. Right. Any other questions? I like those who engage so that it helps others also to figure out things. The more you clarify, the more you understand. Right? Because these things are not new, right? I know 90% of you have learned these things before. Now you are going to apply this. At the application level, you need to challenge things. Right, let's move on. So how you measure free cash flows? So I will not spend a lot of time here because there are, we have, when you define free cash flows, depending on the accounting theory you follow, right? The approach, US GAAP is one, IFR is another. There are different ways of defining it, right? But in a broader sense, we have three different buckets in our cash flows: operating cash flow, investing cash flow, financing cash flow. So we need to look at them, and then mainly we look at the operating cash flow, and then we have to figure out free. I told you free is uncommitted, right? So then uncommitted, we need to eliminate things that are not considered in our cash flow calculation or your cash flow statement, but are committed, right? Right. So this is just an indicative format. In real life, you may not stick to this. You get the concept or the idea and then try to adjust it, pen down to get the real thing. Right. So operating cash flows. So you plus minus interest, plus minus changes in cash requirement for liquidity, that is the commitments, right? Either way. Right. This is just a format, but for exam purpose, don't worry about these things because these are not very important for me. You know, these are just textbooks things. You can simply look at and see, right? Whether it's this so that whether we take treasury bills or treasury bond, or this so that whether we should take overdraft or fixed deposit. Though these are small minor matters, you can play it accordingly. But my concern is whether you get the overall understanding of the concept. Right. So discount rate, there are different scenarios. Generally, if you have only equity situation in the company, right, no debt, simply your discount rate is the cost of equity. That's very simple. You take the CAPM model and take the equity, right? So we take the free cash flows over the period, and then you have the forecast horizon is what previously you asked, right? What is the period we take, 10 years or 20 years or 5 years? So you look at the forecast horizon. So forecast horizon is, if it is 10 years, so you do the cash flows up to 10 years. Then the continuity doesn't stop there. The company is a going concern, so it will continue forever. So then we calculate the next slot, T1, that is 11th year, right? You take the long-term cash flow beyond that, how the cash flow is going. If the cash flow is growing, then you have to factor the growth factor at the growth factor and see it's a constant growth thereafter, 5%, 10% or whatever. If the cash flow is not growing, it's a constant. Without the growth factor, you put the cash flow. That's a T1, 1 year further down. And then when you discount it, you need to bring it to the value. Right? So the continuing free cash flow is a bulk figure. So we have to calculate what is that exit multiplier into the number. So that's embedded in the formula when you calculate the ratio. It's here, but it's not difficult. You can see here we are looking at in a growth situation. That's why you can see G here, right? Growth. And there's growth, cost minus E, right? The E minus G is your formula, right? But there's a problem with these models. I will come to that later anyway. So when you have this growth model, this is affecting even the dividend thing. When there's a growth thing, if your growth is greater than the cost, let's say your cost of funds is 5%, your growth is 8%, this becomes a minus thing. So then your entire formula becomes, meaningless. So there are practical problems also when we use some of these technical models, because if there are certain parameters going in different directions, the formula becomes meaningless. Anyway, nevertheless, this is how it works, right? So I don't want to take a lot of time on those things. These are straightforward stuff where you know the formula, you substitute the numbers and you get the answer. Then you have debt equity situation. We bring the debt also into the picture. So when the cash flow take from both, we take the total cash flow coming in, then the weighted average cost of capital model, right? You take debt and equity both into the picture, right? Right. So the continuing value, like the previous one, continuing value t plus 1, we take the way we discussed earlier. Don't worry too much about these complicated formulas, because I'm not very much interested in these complicated formulas, because at the end of the day, what I'm interested in is your knowledge about this concept and how you apply it. So when it comes to calculation, you can even go to internet, find out the formula, substitute the number, you can get it. That's not a big deal. But what is required is your knowledge of handling it and knowledge of interpreting it. Right? Right. Okay, then here, once you apply this model, you arrive at a figure. I told you the figure that you are going to arrive at is not a definite figure that is hidden. It's a kind of approximation, right? It's an approximation. Then you need to look at what are the possible variations. We do a sensitivity analysis. What is sensitivity analysis? We change the outcome by modifying the input variables and see what if this happens, what if this happens, what if this happens, right? So you change the assumptions, you change the parameters and see what the outcome is. But that will give you a feeling, okay, we assume the interest rate to be 10% in the market, but if the interest rate is actually 15%, where we are going to end up? So that gives you a range to work on and say, look here, depending on where the interest rate fluctuates in the market, the value of this company can go up and down. Now, classic example is what is happening now. So the government has now declared the domestic debt restructuring, DDR, right? Some of you may have already read this. So the DDR, they are talking about how they are going to restructure the debt, the treasury bill, treasury bond, right? The treasury bills will be converted to treasury bonds and they will reprice them. Now, when this rate changes, the value of the bonds and bills will change now, right? The value can come and down based on these movements. Same way, we presume some scenarios and see what can happen. You can take one by one at a time, or you can take a collective movements, right? This goes up, this goes down together. So what if both of these variables going in this direction at once given a situation? Look at those situations, right? Right. Then this cash flow basis method, what are the pluses and minuses? And I told at the beginning also, cash flow is the ultimate truth, ultimate form of value creation. So therefore, it has more economic meaning than other things because it's tangible, can be seen. Then finally, we are arriving at these numbers based on what the company is planning to do and how the company is going to derive the cash from different buckets. Therefore, it helps to justify. And also, this perspective is useful for people whoever is investing or acquiring because it clearly indicates how much money you are getting into your hand. That's the basis you are taking in this, right? In the sense, hand in the sense, in cash, how much you are going to generate, right? So if you buy this company, you are buying this much of cash, right? And in practice, this is the mostly used method because when we discuss the other method, we'll see that there are issues which you take profit is highly subject to due to accounting policies and various other factors coming into the picture, and then the profit can vary. There can be manipulations, but cash you can't do that. So due to those reasons, this is the widely used method. And the disadvantage We have to forecast the cash flows, getting into all these nitty-gritties. It's a time consuming and a costly affair. And also the continuing value, as I told you, because after the horizon, time horizon, the exit thing. So whatever the value we are going to take as the next phase is highly subjective. Right? It can have influence over the assumptions and the discount rate. And also, there is also a possibility of estimation errors. And we say we are planning for the next 10 years. The things doesn't work that way. The world is changing rapidly, uncertain. But when you are trying to fix assumption for a longer period, it sometimes doesn't make sense in reality. Right? So those are the problems we have in that. Okay. So we're done with the lesson. So we are on track now. So I have completed 2 lessons within 2 sessions. So I have 2 more sessions to capture the balance thing. Probably we are meeting in person next time, right? Any questions, clarifications?
So if we can discuss like past paper kind of a question pertaining to the formulas that we have used in next session or after session, so that would be.
So what I will do is, let me first finish the lessons.
Yes, sir.
Right. So after the last session, we'll try to finish the lessons a little earlier. We'll keep some time, and then we'll try to do some examples on past papers possible, or some exam possible questions, some questions we'll do. Okay. Good night then. We'll see you the next day.
Good night, sir.
Good night, sir.